Welcome to the channel. Today, we're diving into the Boglehead's Guide to Retirement Planning. This book cuts through the noise and gives you a clear, actionable roadmap to building a secure retirement. We're talking about practical, realistic advice that anyone can use. This isn't about getting rich quick. It's about making smart, informed decisions with your money today for a stress-free tomorrow. We'll break down the key takeaways from the book, step by step, so you can master your own retirement plan. Let's get started. Before you invest a single dollar, figure out how much money you'll need in retirement. A good rule of thumb is the 80% rule. You'll need about 80% of your pre-retirement income. When you're retired, your expenses should go down. Use a retirement calculator to estimate how much you need to save. There are tons of free ones online, or use the one we've linked below. Just plug in your information like your age, income, and retirement age. For example, if you're 30, making $60,000 a year and want to retire at 65, you'd need around $1.5 million. The earlier you start, the easier it will be. Thanks to compound interest earning interest on your interest, your money grows exponentially. It's like a snowball effect. The earlier you start rolling that snowball, the bigger it gets over time. I know what you're thinking. How am I supposed to save for retirement? It seems daunting, right? Trust me, I get it. Even small contributions can make a huge difference over time, thanks to the magic of compound interest. It's like planting a tree. It grows slowly at first, but over time it becomes a mighty oak. Let's say you invest $100 every month, starting at age 25, and earn an average annual return of 7%. It might not seem like much now, but it adds up. By 65, you'll have over $230,000. That's a substantial nest egg for your golden years. Now imagine you waited until 35 to start investing that same $100 a month. Just a 10-year delay can have a big impact. You'd end up with just over $100,000 at 65. That's a significant difference. That's a difference of over $130,000 just by starting 10 years earlier. Time truly is your greatest asset. Even if you can only afford to invest a small amount right now, do it. Every little bit helps. It's one of the best investments you can make in your future. Your future self will thank you. Think of it this way. You wouldn't wait until you're 50 to start saving for your kids' college fund, would you? The same principle applies to your retirement. The earlier you start, the less you have to contribute each month to reach your goals. Start now and let time work in your favor. Now, let's talk about where to invest your money. The Bogleheads are big fans of low-cost index funds, and for good reason. An index fund is like a basket of stocks that tracks a specific market index, like the S&P 500. Instead of picking individual stocks, you're buying a piece of the entire market. And because index funds are passively managed, they have much lower fees than actively managed funds. Those fees can eat into your returns over time. Think of it like ordering a pizza. Would you rather pay $20 for a plain cheese pizza or $30 for the same pizza with a few extra toppings? Probably the $20 pizza, right? Some popular index funds include the Vanguard Total Stock Market Index Fund, VSAX, and the Schwab Total Stock Market Index, SWTSX. These funds give you broad exposure to the entire stock market, making them a great foundation for your retirement portfolio. Remember, investing doesn't have to be complicated. Max out tax-advantaged accounts. It's like getting free money. Boost your retirement savings by taking advantage of tax-advantaged accounts like 401(k)s and IRAs. These accounts offer tax breaks that can save you thousands of dollars over time. With a 401(k), you contribute pre-tax dollars, which means you don't pay taxes on that money until you withdraw it in retirement. Plus, many employers offer a matching contribution-free money. Make sure you're contributing enough to get the full employer match. IRAs, or individual retirement accounts, are another great option. There are two main types: traditional IRAs and Roth IRAs. Choosing between a traditional and Roth IRA depends on your individual circumstances. So talk to a financial advisor to see which one makes more sense for you. Don't forget bonds. Why you need them in your portfolio. While stocks are great for growth, bonds are essential for stability in your retirement portfolio. Think of bonds like the steady eddy of the investment world. They may not have the same high growth potential as stocks, but they offer a level of stability that can help you sleep at night. Bonds are essentially loans that you make to governments or corporations. In return, they pay you a fixed interest rate over a set period of time. The Bogleheads recommend having a certain percentage of your portfolio in bonds, depending on your age. A general rule of thumb is to subtract your age from 100, and that's the percentage you should have in stocks. The rest should be in bonds. For example, if you're 30 years old, you'd have 70% in stocks and 30% in bonds. As you get closer to retirement, you'll gradually shift more of your portfolio into bonds to protect your nest egg. This is known as asset allocation, and it's a crucial part of managing risk in your portfolio. By diversifying your investments, you can balance the potential for growth with the need for security. Bonds play a key role in this strategy, offering a predictable income stream and reducing overall portfolio volatility. So don't overlook the importance of bonds in your financial planning. Stay the course. Ignore the noise and avoid these common mistakes. Investing can be an emotional roller coaster. The market goes up, the market goes down, and it's easy to get caught up in the hype. But one of the most important things you can do is stay the course. Don't panic sell when the market takes a dip. Remember, you're investing for the long haul, and short-term fluctuations are normal. In fact, market downturns can be a good opportunity to buy stocks at a discount. Another common mistake people make is trying to time the market. They think they can predict when the market will go up or down and try to buy low and sell high. But the truth is, no one can consistently time the market, not even the experts. Instead of trying to outsmart the market, focus on what you can control: your savings rate, your investment expenses, and your emotions. Stay disciplined, stick to your plan, and tune out the noise. And speaking of expenses, be mindful of those too. Keep it simple. Simplicity is often the key to success. You don't need a fancy degree to invest. In fact, many successful investors have no formal financial education. The Bogleheads are all about simplicity when it comes to investing. They advocate for straightforward, easy-to-understand strategies. You don't need a fancy financial degree or a complex investment strategy to be successful. Simple strategies can often yield the best results. In fact, often the simpler, the better. Complexity can lead to confusion and mistakes. Remember those low-cost index funds we talked about earlier? They are a great tool for keeping things simple. They can be the foundation of a simple yet effective retirement portfolio, a solid base for your financial future. You can create a diversified portfolio with just a handful of index funds covering different asset classes like U.S. stocks, international stocks, and bonds. This diversification helps manage risk. For example, a simple 3-fund portfolio might include 40% in a U.S. total stock market index fund, like VTSX or SWTSX. These funds cover a broad range of U.S. companies. 20% in an international stock market index fund like VEXUS or IXUS. This adds global exposure to your portfolio. And 40% in a U.S. total bond market index fund like BND or AGG. That's it. Bonds provide stability and income. This simple portfolio gives you exposure to a wide range of assets, and it's easy to manage. No need for constant adjustments. Remember, investing doesn't have to be complicated. Simple strategies can be very effective. Stick to the basics, keep your costs low, and stay disciplined. Consistency is key. You'll be well on your way to a comfortable retirement. Enjoy the peace of mind that comes with a well-planned investment strategy. Reassess your plan. Life changes, so should your retirement plan. Life is full of surprises, and your retirement plan should be flexible enough to adapt to those changes. That's why it's crucial to reassess your plan at least once a year, or whenever you experience a major life event, like getting married, having a child, or changing careers. During your annual review, take a look at your savings rate, asset allocation, investment expenses, and retirement goals. If you're not sure how to reassess your plan, seek help from a financial advisor. They can provide personalized guidance and help you make any necessary adjustments. By regularly reviewing and adjusting your plan, you'll be better prepared for whatever life throws your way. Congratulations! You're now a retirement planning pro. That's it for our breakdown of the Boglehead's Guide to Retirement Planning. If you found this video helpful, please give it a thumbs up and share it with a friend who might benefit from it too. And don't forget to subscribe to our channel for more videos on personal finance, investing, and building wealth. Thanks for watching.